This week marks nothing less than the end of an era for global financial markets. On Wednesday, Jerome Powell stepped in front of the cameras for the very last time as chair of the Federal Reserve. After roughly 8 years at the helm of the world's most powerful central bank, he leaves behind a legacy that divides opinions and has thrown markets into deep uncertainty. While the Fed kept its benchmark rate steady between 3.5 and 3.75%, things were boiling behind the scenes. 4 members of the FOMC voted against the majority. An 8-4 split, we rarely see this sharp. Powell's farewell remarks sounded almost stoically neutral. He claims they're still watching inflation closely, that rates are the upper end of neutral and that the economy is robust. But if you look closely, you can see the cracks in the foundation. Data from the University of Michigan tells a completely different story. Economic conditions in the US are at the lowest level in 10 years. This is where the Fed's official narrative collides head-on with the brutal reality everyday Americans are facing. And while you're watching this video over the long weekend, you actually have the time to position yourself properly before the markets open again on Monday. So the big question on everyone's mind, what happens next? With Kevin Warsh stepping in, are we heading back to hard currency discipline, or is the house of cards built on debt and money printing finally about to collapse? Today, we are cutting through the emotional noise and focusing purely on the facts and the strategic analysis. What does this transition mean for your portfolio in gold, silver and copper? Your time is valuable, so let's dive right in. Quick disclaimer up front, this is not investment advice, just my personal opinion. Always make your own investment decisions and at your own risk. Before we look ahead, we need to look at the raw numbers from the Powell era. And these numbers are a slap in the face for anyone who believes in sound monetary policy. During Powell's term, the US money supply exploded by a staggering 63%. That's the most aggressive money printing we've ever seen in this form. The consequence? The highest inflation since the 1970s. But for us as precious metals investors, there's another side to that coin. Over the same period, the gold price climbed by 248%. That's a performance well above what we saw under either of his two predecessors. Gold did exactly what it's supposed to do. It protected purchasing power against the massive expansion of the money supply. Powell leaves behind a system flooded with liquidity while the mountains of debt have grown into the sky. If you're wondering today why gold and silver are holding up so well despite high interest rates, the answer lies buried in this massive balance sheet expansion. It's a vote of no confidence against a system that's only being kept alive by the printing press. But now Kevin Warsh enters the stage. Mainstream media is already celebrating him as the savior of the Fed credibility. They want us to believe he will single-handedly beat inflation back down to 2% and that this means the end for gold and silver. The market has already reacted. Since the announcement of his nomination, we've seen a clear pullback in precious metals. But is the pessimism justified? Or are we witnessing the cleansing process before the rally moves into the next phase? Let's take a closer look at Kevin Warsh. Away from the headlines, he's known as a defender of a strong US dollar. At first glance, that sounds like a headwind for gold, but we need to keep a cool head and look at the history books. Remember February 2018, when Jerome Powell took over from Janet Yellen? The narrative was exactly the same. The media painted him as a hawk who would tame inflation and restore stability. The result? A short-term pullback in the gold price of 14%, only to break out to new all-time highs afterward. Reality catches up with every Fed chair faster than that like. And reality in 2026 means nearly $40 trillion in US national debt. Interest payments alone are now costing the US budget around $1 trillion per year. That's a mathematical prison. Kevin Warsh is being brought in as a crisis manager to ease the pain. If we analyze his statement carefully, it becomes clear where this is heading. He talks a lot about AI-driven productivity gains that are supposed to be disinflationary. That's the perfect excuse to cut rates without officially abandoning inflation targets. He wants to lower rates to ease the government's debt service and to fuel Trump's economic engine. At the same time, he says he doesn't want to expand the Fed's balance sheet any further. But we saw in 2024 and 2025 that the money supply and gold prices can rise even while the Fed is officially running quantitative tightening. And in this case, you're thinking right right now. Quantitative what? Don't worry, quick detour so we are all on the same page. Quantitative tightening, or QT, is basically the opposite of money printing. Picture the Fed as a giant sponge. During the crisis of 2008 and 2020, this sponge soaked up trillions in bonds and pumped fresh money into the system. With QT, the sponge is now slowly being wrung out. The Fed lets its bonds mature without reinvesting, theoretically pulling liquidity out of the market. But here's where it gets interesting. While the Fed squeezes the sponge with one hand, the US Treasury opens the floodgates with the other, by drawing down its reserves and taking on new debt at the same time. On top of that, there's the so-called reverse repo facility, which you can think of as a parking lot for excess liquidity that was systematically emptied out in 2024. So the money that's pulled out on paper flows right back into the system through the back door. On the Fed's balance sheet, it says tightening. But in the real economy, liquidity keeps arriving. And that's exactly why gold and silver keep climbing, even though the central bank is officially hitting the brakes. And that's the key point. The system forces liquidity through other channels. Warsh is not a game changer, he's a system maintainer. And as long as government spending keeps exploding, especially in defense with another $500 billion in additional budget on the way, the long-term trend for gold and silver remains unbreakable. Now let's get to the point that's crucial for your short-term strategy, the US dollar. But before we dive deep into the dollar, there's one factor you absolutely need to keep in mind: the Iran conflict and the partial blockade of the Strait of Hormuz. This crisis is keeping energy prices elevated, and that was the main reason the Fed didn't cut on Wednesday despite weak economic data. 4 members voted against, because they see the inflation risks from energy prices. The moment this situation eases, one of the biggest brakes on rate cuts disappears. And that's exactly the trigger I'm waiting for. Right now, the market isn't pricing in any rate cuts for 2026. In my opinion, a massive miscalculation. The moment the market starts pricing those cuts back in, the dollar index will come under pressure. We are seeing a textbook bear flag in the chart, and a break below 90 would be like rocket fuel for gold and silver, comparable to the early 2000s, when the dollar's collapse triggered a multi-year commodity bull run. What we are seeing right now is a technical cleansing of the market, a shakeout of weak hands before the next leg up. Here's something especially interesting. While gold in US dollar has risen about 149% since the 2011 highs, the gain in other major currencies averages 315%. So the dollar gold price has massive catch-up potential, and once dollar strength starts to crack, that gap will close. I expect the bottom for this pullback around Warsh's second meeting as Fed chair. By the way, feel free to subscribe if you don't want to miss any analysis like this in the future. While everyone's staring at gold and silver, something almost eerie is happening in the background with copper. Copper prices are still trading extremely close to their all-time highs and have corrected far less than gold and platinum. Why is that? Because copper is the backbone of the AI revolution. The massive data centers being built around the world are devouring unbelievable amounts of copper. And just like with silver, we have a massive structural deficit here. Between 2012 and 2023, far too little was invested in new mines. It takes years, if not decades, to bring a new copper mine online. What we are seeing is not a hype, it's fundamental scarcity. The US is desperately trying to secure supply contracts because China has effectively controlled the market in recent years. So how do you best invest here? A lot of viewers ask me about copper investments, but here's where the danger trap is hiding. If you buy physical copper, rounds or bars today, you'll often pay markups of over 1000% on the spot price. That's absolute madness. An ounce of copper, which is only worth a few cents industrially, gets sold in the precious metals trade for 5 euros or more. You're buying an industrial metal at collector prices. That makes 0 sense as an investment, unless you want to wallpaper your house with it. If you want to profit from the copper story, you need to take a look at the stock market, and especially at mining stocks. Before we head into the next section, where I'm getting really concrete, another reminder that this is not investment advice. The stocks and ETFs we are about to discuss are highly volatile and come with risk, but they also offer big opportunities. With copper, the leverage on mining stocks is significantly stronger than with silver or gold. While good silver miners often leverages the metal price by a factor of 1.5 to 2, copper miners often show leverage of 3 or more. That's because of the cost structure. Labor and equipment costs are largely fixed, while every cent of copper price increase flows straight into profits. A prime example is the COPX ETF. While the copper price rose about 30% over the past year, this ETF gained over 100%. That's the power of leverage. If you want to position yourself in copper, take a look at the top holdings of ETFs like that. That's how I do it. Names like Lundin Mining have massively outperformed the S&P 500 over the past year. But careful, invest in companies that are already producing, rather than betting on pure exploration plays. The risk of total loss with explorers is enormous, especially in a volatile rate environment. My plan is pretty simple. I'm using the current weakness across the entire commodity sector to build positions in quality miners. We're in a phase where the masses are selling out of fear of Kevin Walsh and the strong US dollar. For me, that's the classic contrarian opportunity. If you think long term, you know that the devaluation of the dollar and the industry's hunger for raw materials won't be stopped by a change at the top of the Fed. Which exact stocks I'm buying? I will reveal that in one of my next videos. So if you don't want to miss it, and if you enjoyed this video, drop a sub. But here's what's the most important to me. Be genuinely patient, use chart and fundamental analysis, and don't let short-term red candles drive you crazy. You can find a video here on Novo Nordisk where I break down whether the stock is still a buy, and here you'll learn about the 12 risks lurking in the MSCI world right now. See you in the next video.